Joining us now, Chris Verrone, partner and head of technical analysis at Strategas Securities, and Mike Santoli, CNBC's senior markets commentator. I just want to start, since you're technical, Chris, I want to start with Mike. So we were talking earlier that, like so many other quarters, expectations are at a point where we're getting a lot of beats.
Yeah.
And I want to know whether year over year these are good numbers, or they're flat. Are they up 2%?
Flattish.
2%?
I think it's been 3 quarters of flattish and up a slight bit. I mean, I don't know. That's a bragging rights thing. I don't think it actually matters for the market because it doesn't trade in aggregates that much. But I do think, if you looked at the estimates for this quarter on June 30th when the quarter started, they're much higher than what the companies are going up against right now as they report. And that's the standard cycle. I think it's a deeper revision kind of cycle this quarter. So I think the big question is this the trough? And then up from here, more than it is, do we go down 1% or up 2%?
Chris, what is the action that we're seeing after companies report? What's that showing?
Well, I think what's so remarkable, and Mike touches on this, the bar of expectations was low into these, right? Think about all the headlines out there: Brexit, China, trade, recession. But then we juxtapose that with the price action. Industrials act great. Apple at a 52-week high. JP Morgan 52-week high. Housing stocks 52-week high. Semis acting well. The message of the market is pretty constructive here, and I think the mistake is getting too wrapped around the headlines and ignoring the price action. The price action is pretty darn good.
Yeah, I mean, I would absolutely agree with that. If you looked at the industrials yesterday outside of Boeing, they were up pretty strongly. Also, among the list of worry points from August was the yield curve, and yesterday, 2-year versus 10-year yield curve is up 20 basis points. I mean, I think that has to be the backdrop. Right now, the equity market really kind of wants and needs yields to click higher. And so that's the pattern we're in. I think the one thing I'm focused on is, are we going to kind of grind our way to a high just in time for the Fed meeting? Again, if you look at the last 3 or 4, that has been a stall point or an opportunity for a pullback. But right now, the market itself isn't telling you that's what's going on.
And Mike, I might just add, what's so remarkable around the world is what is not getting attention. DAX, 52-week high. This is an export-driven market telling you things are getting better. You've seen it even with the...
Things are getting better, or there might be an actual agreement with the UK over Brexit. Like what does that tell us?
Well, I think what's notable is even from a leadership perspective, DAX is outperforming rest of world. European autos starting to turn. European banks acting better. Taiwan, new 52-week high, biggest semiconductor market out there. So there are these signs of global cyclicality that have started to emerge over recent weeks and recent months. People aren't positioned for it. And I think that's the big distinction here.
Yeah, the positioning piece has been the context of it. And I think context is its own catalyst for a while. People just get too negative, and it requires more incremental negative news to kind of keep stocks where they are because people haven't been in enough.
Would the Fed not lowering rates be incremental negative news that would continue to drip?
I think there would have to be a little bit of make our peace with that decision and know that they're still flexible. And also, I think there would probably be a message in the fact that they're in the blackout window right now. They can't really massage expectations. So it would be a little bit of a jarring move. But I don't think the real signal of that would be a negative, because I think they would feel like the economy is holding together, trade incrementally got less threatening, and we're okay.
And I would just add to that, Mike, I think notably the uninversion of the yield curve over recent weeks has gotten considerably less attention than the inversion of the curve. And as the curve has actually steepened here, what's acted better? Banks in all corners of the world are acting better. JP Morgan, the most important bank stock, 52-week high. Regionals starting to outperform here a little bit. So up and down the cap scale, as the curve has steepened, that group has gotten better.